Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Kevin Davitt, Head of Index Options Content at Nasdaq, as well as Jim Carroll, Senior Wealth Advisor and Portfolio Manager at Ballast Rock Private Wealth. We're here to discuss the volatility market and equities. Are they discounting the impact of higher tariffs and higher interest rates too much? It's great to have the both of you with us. Welcome to Trade Talks, Jim. And that really is the question, right? Equity markets, they topped 2 months ago, and since then, it's really been a wild ride round tripping here. What's Ballast Rock's take on the current backdrop?
Well, our take is that we're coming off of 2 years of outsized performance for U.S. equity markets. That may continue in a big, beautiful way, but we want to be thoughtful about the possibility that the bouts of volatility we experienced starting last August may just be the beginning of a longer regime of high volatility. We're also on record saying that the traditional 60/40 portfolio may not manage risk the way it did when interest rates were on a generational decline. So we want to make sure that we're building portfolios that are able to participate in future ups, also providing definitive protection on the downside. We're also actively engaging with clients about tax mitigation so that they keep more of what we make.
Yeah. And Kevin, from a volatility perspective, how would you characterize the past 2 months in the Nasdaq 100?
Volatility perspective, plenty of it. I think that's a fun question. As your audience likely knows, with any kind of volatility measure, your time window matters, and Jim certainly knows this. So I looked at realized volatility on an annualized basis and went back to 2007. I looked at both the Nasdaq 100 and the S&Ps. On average, the Nasdaq 100 has realized 3.3 vol points higher than the S&Ps. That's probably not surprising to anyone that follows markets. If we put that a little bit more concretely, on average, annualized NDX vol runs around 21.8%. That compares to the S&Ps at 18.5%. Again, that 3.3 vol point spread. Now, that relationship obviously ebbs and flows. It was widest back in 2022, as Jim alluded to. The 60/40 portfolio was very, very challenged given the dynamics in the equities and the bond market. At that point, NASDAQ 100 realized vol was an 8-point premium to the S&Ps. And what we're seeing again this year is an unusually wide spread. It's not quite out to the levels from 22, but year to date, that spread has averaged just over 6 vols. That, of course, gets translated into the index options market, which is something Jim knows a whole lot about. You see it in measures like that some market participants gravitate toward NDX when they anticipate vol might pick up. I think that short-term option, index option traders might be inclined to own NDX optionality. Spread widens to position for some kind of mean reversion. And then one last thing, which I have mentioned on your show in the past, Jill, is that our group is seeing a pickup in interest in longer dated NDX exposures. So looking out like well more than a year out in time, those options have considerable vega. And a bigger picture takeaway might be if you're looking to express an outlook predicated on volatility, NDX options on average have roughly 3 times the vega of similar S&P options when you look at like options in terms of like tenor and moneyness. There's always going to be something in the index volatility land to talk about, and Jim does it so well.
Yeah. And Jim, we've been covering quite extensively the growth of buffered ETFs. It's garnering a lot of
volatility premium as a portion of the buffer that you're creating. You essentially are getting more bang for your buck when volatility is high. It can be it can be a little daunting to be selling option premium when volatility is at the upper limits of history, but that tends to be a good thing. And as a result, we're finding opportunities to, we're not replacing equity exposure with buffered ETFs, but we're blending our portfolios to take advantage of what we see as good structural instruments that give us some downside protection while continuing to let us participate in the upside.
Right. And Jim, of course, the benefit to that is, as an individual investor trying to replicate that strategy, you wouldn't have the efficiency, or the economics would change. So that's why having it within these fund or an ETF wrapper is beneficial for the retail investor.
Absolutely.
Yeah.
Yeah,
Kevin,
one of the things, the only thing I would say there is, and Christian Salomon, our chief investment officer, has been with you before. He came off of a derivatives trading desk.
yeah.
He used to joke with us that he could do these in-house, and we said, do you really want to be doing that all day every day, or would you rather pay some other professionals to do it for us in an ETF wrapper? And he said, yeah, I guess you're right.
Yeah, well, I would agree with him. There's certainly a number of advantages to that. Kevin, you've spoken about the growth of options-based ETFs on Trade Talks, virtually every episode that you've been on. Has anything changed in your view, giving the asset under management growth and the shifting economics and the way the market has been acting as of late?
So I think the attention that's been paid more broadly to the growth of these products has changed. There's been some really interesting discourse on both sides of the aisle. I think sometimes what's missed there is that you need to think about the end user, and you talked a bit about the economics. Plenty of individuals could manage options exposures on their own, but there's a trade-off to that, and the efficiencies that the market offers in terms of very, very cheap option-based exposure, I think have been really attractive to this growing cohort of the aging US population. And people appreciate the ability to have some equity exposure, but with volatility constraints that look a bit more like fixed income exposure. So you're kind of trading some of that potential upside for reduced volatility. And I think that will continue to be attractive given sort of the overall growth in this area. But I think there's arguments to be made either way. I think there is tremendous capacity for growth here, given the products that they're generally focused on are index based, like the Nasdaq 100.
Yeah. And that's a great point that you bring up, Kevin, understanding who your audience is, right? It's not necessarily always a one size fits all black box solution. And I think that's an important distinction to make.
Yeah, if you're aiming and comfortable with full equity exposure and the volatility that comes along with that, then that's kind of your benchmark. But looking at products like this and comparing it to straight up equity exposure is arguably unfair. And I think that these types of exposures, that the end users understand that trade-off and they're more than willing to accept it.
All right. Appreciate
And
both.
I would
I'm
add
sorry, go
one
ahead,
thing
Jim.
if I could, Jill. Yeah, no, Kevin teased at it, but one of the things that buffered ETFs can do is really serve as a fixed income replacement at a time when the volatility in the fixed income market is rivaling the volatility in the equity market.
That's a really good point. That is the one area of the market where volatility has remained persistently high, kind of post 2022. Really, really good work in there, Jim.
Jim, actually, let me follow up on that. When you said that it somewhat mimics, those portfolios mimic each other, in what way, as you compare it to fixed income and the derivative markets?
Sure. Historically, people have seen fixed income as a source of income,
Right.
and as a less volatile holding in portfolios. So it has had a great diversifying impact. That has changed in the last few years. And if you go back in history, it's not forever, written in stone that bonds will be a great diversifier and uncorrelated to equity markets. We go through long periods of time where equities and bonds do run the same direction, and that reduces that correlation benefit. So if you think of buffered ETFs, if you think of structured products generally as something that is not going to give you the full upside, that corridor of return that historically we think of coming from fixed income, but with less volatility than we've seen in fixed income, and a more reliable performance.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.